Hi everyone, this is Group 6 of Phi Chi Theta. Today we will be giving an analysis on FedEx's earnings report. FedEx is a company that is headquartered in Memphis, Tennessee, which operates across 220 countries and territories and employs over 530,000 people worldwide. Its primary segments include FedEx Express, FedEx Ground, and FedEx Freight. In terms of their earnings, they are a strong indicator for global trade and logistics, and their performance and earnings report mirror global economic trade and supply chain trends.
Next, this slide shows how FedEx fits into the broader parcel and freight market. The global parcel industry is projected to grow from around $400 billion to more than $650 billion by the year 2030. In the US, the LTL market is already worth nearly $60 billion, and it only continues to grow from there. While e-commerce has slowed down from its pandemic boom, it still makes up 15 to 16% of all retail sales. And in parcel delivery, as shown in the graph here, UPS leads the market, followed by FedEx, showing that FedEx remains a key player in both the parcel and freight markets.
So now to talk about the competitive landscape of FedEx. The competitive environment is shifting rapidly, structurally and technologically. Its key competitors include UPS, DHL, Amazon Logistics, and USPS, which you can see some information on the slide here. Also, it's part of a traditional duopoly with UPS, which is actually being eroded right now due to an increase in regional carriers, as well as the increase in large players like Amazon who are internalizing their own logistics networks, which reduces independence on FedEx and UPS.
FedEx's volume story has been shifting dramatically over the past few years, largely during the pandemic. Average daily parcels jumped from about 5.6 million in 2019 to 6.6 million in 2021, which is an 18% surge fueled by e-commerce growth as consumers turn to online shopping. But that momentum has since cooled. Volumes have normalized to about 6 million per day in 2024 as spending patterns are more balanced. So growth tailwinds have been fading, and FedEx can no longer depend on volume expansion for revenue growth. So their future performance will have to hinge on efficiency and cost discipline. With that slower growth, cost management has become the core profit driver. So from 2020 to 2025, you can see that fuel, inflation, and wages have all been pretty volatile and been surging. So to offset these pressures, FedEx launched Drive in 2023, which is a efficiency program focused on consolidating underused hubs, optimizing routes, and eliminating redundancies. Sustaining profitability now depends on these structural and cost improvements. Drive has been showing some pretty good results, which has caused the exceeding of their Q1 estimates. Their business optimization costs have fallen 48%. Their new network is live across 360 North American sites, and a European workforce reduction will save them 150 million annually. So that's $2.2 billion in savings in 2025, and then another billion will be targeted for fiscal year 2026. However, these gains came among some pretty major headwinds in terms of trade policy. So FedEx will face a $1 billion profit hit from trade disruptions, mostly from the weaker China-US shipments due to the tariffs. 300 million will come from higher customs costs, and there is a removal of the $800 de minimis exemption in August 2025. So now low-value imports will also be taxed. Despite these challenges, FedEx has beat Q1 expectations by executing its transformation effectively. However, the key question is that whether or not operational improvements will continue to offset the external trade pressures.
So, as Lucy talked about, FedEx beat their earnings expectations, and after that, in the aftermarket on September 18th, the shares rose 5%, which showed a strong response to, those better than expected Q1 results despite the trade headwinds. So, as for some context on their year-to-date performance, prior to the earnings release in September, the stock had declined more than 18%. And so these earnings really provided relief amid those broader market concerns about the trade policy.
Early in 2025, FedEx's tone was actually very cautious. Management actually withheld full year guidance, saying that they couldn't predict demand because of trade and geopolitical uncertainty. That uncertainty hit investor confidence hard, and you could see it in the chart. The stock kept sliding month after month through the mid-year. That wasn't It wasn't the result that was terrible. It was that investors didn't trust the outlook. Then in September, FedEx finally beat earnings expectations and showed real cost discipline. That's when sentiment flipped. Investors saw proof, not promises, and the rebound began. This moment marked the first sign of recovery after months of doubt, showing that FedEx's turnaround story was finally gaining some traction. Looking down here at this chart at the bottom, the orange slice shows FedEx Freight, the trucking arm that handles less than truckload shipments, which is basically when a truck isn't full of one company's items, but is actually shipping multiple companies at the same time. And it only makes up about 20% of total profits, but it's cost heavy and runs differently from Express and Ground. FedEx plans to spin it off by June 2026, giving shareholders stock in the new company tax-free, meaning they keep the full value of their shares. They spent about 43 million this quarter preparing for it, a short-term cost that helps simplify operations long-term. This move lets FedEx focus on a higher margin parcel delivery while freight can grow independently. In short, they're cutting the complexity now to drive profitability later. Trade policy remains FedEx's biggest headwind going into 2026. With tariff swings and shifting trade routes, planning global operations is difficult. The chart shows that impact. Priority shipments fell nearly 10%, economy rose about 5%, and overall exports dropped around 3%. It's not just fewer shipments, it's fewer customers shipping. It's customers shifting to cheaper, slower services, which means lower margins for FedEx. Management called this a key risk for the next fiscal year, saying trade uncertainty will keep volumes unpredictable. So even though FedEx is getting leaner and more efficient, global volatility still caps their growth potential.
Currently, we can see that FedEx's shipping prices are up, showing strong performance both domestically and internationally. Specifically, we see the table shows a 3% increase in domestic and 13% increase in international packages. However, its freight business is noticeably weaker due to trade tariffs, which are raising costs and slowing shipments down, as seen by the 2% decline of daily shipments and 16% decline in its operating margin, which shows its profitability per individual shipment. Right now, FedEx is also cutting $1 billion in its costs and finishing its freight spinoff, which will promote them to stay competitive in the market in the future. This final slide shows the main and key takeaways of how FedEx has transformed over the years. After the pandemic surge and there were rising costs, the company launched major cost-cutting and modernization programs like Drive, which Lucy talked about earlier, and Network 2.0. It's also now spinning off its freight division, which we also talked about, to streamline operations. And despite trade challenges in the past, FedEx has delivered a strong earning this past quarter.
Here are a couple sources that we reference in our presentation, and thank you for watching and thank you for your time.